We have a crazy market right now, and we have so much to cover in this video today to teach you about what's going on in the market. We got SpaceX out here saying they're going to IPO. We got US retail sales actually coming in and beating expectations. We got a NASDAQ up 1% today for the first time in 2 days. We got a growth stocks like Celsius. What are people saying about them after they've still been getting destroyed from their all-time highs, almost 50% down? And then we got this great video to listen to from the head of JP Morgan Strategy and see what she has to say about this market and then dynamic. Let's get right into this video. Let's teach you the first teaching point we want to get to today is probably the most important aspect of this video. So SpaceX is coming in and filing for an IPO later this year. Some people are thinking it's going to be June. Who knows what they're going to use in investment banks. Should you be buying this IPO right whenever it comes out? No, no, no. One of the cardinal rules of investing is you don't just go and buy IPOs right whenever they come out, because basically, I'll just teach you this while I look up this stock to show you what in the world, I think you've seen this Figma, right? So basically, whenever you have an IPO, right, what in the world happens? Look at this stock goes like 100 something, now it's down at $20. But whenever you have an IPO, right, an investment bank's there, the company's there. What do they want to do? They want their shares to be priced as high as possible. Because what in the world does that do? One, the investment bank who helps them with the M&A generates so much more fee revenue with higher pricing. B, the company, a lot of their insiders and the people who've built it, their CEO, their CFO, all of these people are paid in stock-based options, right? If the stock price is so much higher whenever they come out with this stock, what does that do? They get to sell their stocks for higher and higher prices, leading to them making more money. So that there's so much in it for people in the companies to go and say, hey, I want to go and get the stock higher because I'm going to make more money, while the investors are going to be like, oh my gosh, this is great. This stock is great, great, great. It's going to go so high. But it never does. It always goes down. So say the stock IPOs, and then in a year or two, it gets hit by 50, 60%. Then that's whenever I would start looking into the stock. So that's just anything you have to understand about any IPOs in the market, because they're going to come out overpriced. They're going to come out over their fundamentals, and they want you to buy them. The next thing I want to get into is what is the stock we keep talking about. Celsius over here. They're still getting killed. Let's see what they were doing today, right? They're down from their highs at like 58 recently, those highs, and they still went down 3.24%, even though the market went up about 1%. Basically, Celsius, people are worried about the cost. Like, we have a whole video on that about why you should be buying it, and how I said I hope it goes down more and more, because I will keep buying more and more of that stock and take up all the shares I can get at these prices, and eventually I could get a 3x in that stock each year, which would be great, right? So basically, people are kind of worried that their free cash flow, their margins are going to shrink because costs are going to take that over. That's not going to happen. This is short-term news in a long-term game. Let me just go and pull up what we have for our Celsius price projections, right? Move this over here for you guys to see. Basically, by 2029, we have their midpoint at about $60. If they go anything under 30, go to 25, you're getting over a 6x, maybe even to 7x if they keep going down more and more. At their top of the case, you're getting a $250 price. You could get a 10x in 4 years from an energy drink brand. An energy drink, consumer staple, consumer discretionary company. You don't get these opportunities every day. These are stocks that you're going to go to sleep really calm at night, have great balance sheets, great income statements, great management, who keep on growing the brand. And like we said, people go to the gym. We have girls drinking the Ilanis every day. That brings a growth back and a devoted customer base that almost has a moat in other companies in a hard sector. On top of this year, like we said, we get up to 90, you could get a 3x on your investment, which is unbelievable for this stock. So that's what we love about Celsius, just to reiterate that point right here. Let's just go in here and let's listen to this year with this video from YouTube and with the people talking about it, right? Just take a listen. We're going to butt in once it starts loading.
How do you separate what's happening in the Middle East, the global concerns, the potential threats, with the fundamentals for what stocks are doing right now?
There are two major things going on in the markets right now. One is this tension between sentiment and fundamentals, which I think will probably be with us for the whole year, because it was with us before the war. And while right now market sentiment is very sensitive to headlines, if you look at the fundamentals within the economy, if there is a war going on, nobody told earnings estimates. because you see earnings estimates for the S&P 500 going from 15% coming into the year to now 17% as we're on the eve of earnings season. So ultimately, it's actually looking like earnings could be even stronger than the prior 2 years when we had double-digit earnings growth. And a lot of the guidance you're getting from companies is still positive. Now, even if we see some of that revised back because of some of these challenges due to higher energy prices and higher input costs, you're still likely to end up with a year with very strong fundamentals paired with very sour sentiment.
So does that mean stocks look cheap to you at this point?
In some pockets, certainly. And what's been interesting, too, is while you see the VIX elevated and you see volatility overall high, you see single stock volatility even higher when you look at that constituent level volatility. So what's going on underneath the surface is it's unearthing a lot of different opportunities.
And just on this point, like you said, you're having so many opportunities in the stock market. The fundamentals are really outpacing the price right now. And that's why we keep talking and saying this is a stock picker's market. This is a market where we're going to go out and buy an AMD, buy a SoFi, buy Celsius that are intrinsically undervalued to get to their price, or even a Zeta, even an NVIDIA, right? These companies here are trading at super low 4P ratios, have been sandbagging on their earnings are going to even beat them. They've been doing for years. And they're still getting sold off 50% down in this market for no reason on some conflict happening all the way in the Middle East. That is the difference between you go and you buy in like a company that's still flying through this, like an energy company, something that XLE that's up 30-40% this year like we had on our video last night. You're going to buy these stocks, and even if they go down 10-15% more, you're going to add to them. And then you're going to look at your portfolio in a year, 2 years, 3 years, and you're going to be like, how am I up already double? How am I up 5x? And how am I up 10x? Markets like this, whenever they're not even down 10%, are what make your portfolio, because these are just such eye-opening times. Whenever you have a fear and greed down below 20, you have a VIX, like we said, still elevated at 25. These are just great buying times. And I'm not saying, hey, go and sell my house, take out a mortgage with these crazy rates, and go all in. This isn't the time yet. If you see a VIX over 50 and you want to do that, it's your life. You make your choice. You know the information. But if it's over 50, I'm going all into my portfolio personally. I'm going liquidating everything. I'm going in the market because that's going to bounce soon. Right now, could it go down more? Could you see SoFi going 10%, 20% more? Could this market go down over 20%? Absolutely. Some of the data, CPI or something comes in bad, PPI because of this gas, and even if the war ends, it takes time to clear up. That could happen. But right now, you're getting fundamentally undervalued companies, and you got to start taking advantage of this and not waiting for the perfect time, because this isn't even close to a huge down market.
You have about 58% of the stocks within the S&P 500 outperforming the index, and I know that's a relatively low bar, but that's still the highest share if we ended the year today since 2022 and 2010 before that. And usually what you tend to see in periods like this is correlations go up amongst stocks because everything goes down. But right now you're actually seeing relatively low correlations in the context of the last couple of years. And so that does create this environment for stock picking, even in sectors that are not doing well. I mean, financials is basically the worst performing sector this year, and yet you see 42% of stocks within that universe that are actually outperforming the index. So it does create some opportunities underneath the surface at the single stock level.
They're outperforming the index from a stock perspective or from an earnings perspective?
From a stock perspective.
From a stock perspective. I guess you look at the best performer in the Dow for the quarter, it was Chevron, up 35%. 10 out of 11 sectors were down for the month last month. The only one that was up was energy. And there is a real concern. Are these high energy prices going to continue? Because that will have an impact on many of these sectors. Industrials, I think, was the worst sector for the month.
Absolutely. So you have this shorter term sentiment challenge around energy, but you do have some of these longer term secular themes that are still playing out in the markets. I mean, you think about areas like industrials, materials, utilities, you still have this AI layer around infrastructure that's going to continue for many years. You look at some of the deal making that's going on, and it's still at the higher end, at the larger end of deals, prolific considering all the uncertainty out there. So there are pockets where the fundamentals within companies are looking beyond some of these short-term challenges. But I agree with you that, look, the bounce that we're seeing in markets right now could be premature. It could be a little bit short-lived here, because if you don't see free movement of oil and those prices coming down, that is going to be more of a longer-term challenge. But again, you think about a year like 2022, where that continued to be a persistent challenge, but eventually you did see some relief there. And while it took a little while for the rest of the markets to recover, it set us up for a couple of years of really strong returns.
When it comes to AI, what do you like? Because the other issue you can watch is the destructive force of AI. The worst performer in the Dow for the last month was Salesforce, and that's because the concern that AI is going to eat its lunch. What do you like when it comes to AI and big tech?
And just something right here, like those SaaS companies like a Salesforce and Adobe, look at how much these companies are just getting absolutely destroyed out here, right? Let's just go and look in Salesforce. But you're just getting companies here, right, that are just getting absolutely destroyed. That's pretty. Look at this. They were up here at 366. Now they're down 50% from their highs, and nothing's even happened there yet. Let's look at Adobe, right? Even here, Adobe. What in the world is going on there, right? 580. They're down over 2x or 50%, and you're getting a ServiceNow even. They're down. What are they? Their highs were 233. These companies are all down over 50% in this time span, and we don't even know if AI is going to hurt them. These are companies that are embedded in companies where a Salesforce, right? You connect all parts of the business. It's hard to make an AI model. It's really hard to make an AI model to do that, and that's what we're just seeing in this market. It's just a super risk-off sentiment that's got even worse recently, and it's gone from selling AI worried some companies like these SaaS companies to financial sector, which that could be private credit, but you're selling these, and in Nvidia or in AMD, whatever, trillions of capex are being spent on these companies over the next coming years, and it's just like, why are you doing this? Why are you giving us these prices? And as an investor right now, you have to be licking your lips and salivating and saying, thank you for giving me these prices. I'm going to go buy up every possible share I can get in sight for the next few years. Because if your stock goes down over the next 2 months, you should have a little bit of cash on hand with the way the market is right now, even if you're buying heavy right now, which you could be in some of these stocks, and you buy more and more, and eventually it's going to fly up, because this isn't a short-term game. Life isn't short-term. Life isn't a year. Life isn't a day, even though it sometimes feels like that. And that's the same for the stock market. It's a long-term game where stuff doesn't happen overnight. Rome wasn't built overnight. It takes time to build up a portfolio. It takes time to get your life. That's the way that everything's going in this. So you just got to take these advantages and opportunities you're getting in the markets and go and understand what to do. That's what we're going to end up there. And just another good thing, right? The U.S. retail sales are up today. Everyone's like, oh, what's going on in the consumer? Are they not going to be spending? Right? We've been saying consumer discretionary. Are they getting hit? They're getting hit hard because everyone's worried about oil prices and gas prices. Well, guess what? The consumer data came in and they're spending. They beat that. Prediction was 0.3, 0.4 you got for these months. They came out at 0.6. So you're seeing a resilient consumer still through all this. And if you can keep equities up here, you're going to see a resilient consumer buying for this. Now, if inflation and that spurs up and the Fed has to raise rates, that's a different story. But for right now, this market bounce, could it be too fast? Yeah. Let me just show you something here. I have it. Let me just go. I'll have it. Let me go pull my industries real quick here, right? So basically, you can have. It's good to see sometimes in the market what it's doing, because there's just some stuff that you can go and check and say, hey, like, oh, is this gonna be? I think these are the future. You know, it's fine. But you can kind of go and see, like, oh, look at this. Like, look at this volume spike here at the bottom, right? Look at this volume spike. Boom, boom, boom. Boom, at the bottoms. There's nothing crazy there yet. The only one technically you have was right here, but it's nothing insane like the bottom of these volume spikes. Like, look at, boom, here, up here, up here, up here. So I personally, the way that this market also rebounded is because it's short term. The war's going to end, and like they were saying, is some stuff outrunning the fundamentals? Is the company is saying, oh, hey, oil, where it eventually got better in 2022, but it had you have a VIX over 30. It could keep happening. So that's why you just keep cash on hand, and you're like, it's right now, it's happening. No, it's, you got to wait for a huge crash, and you got to be patient sometimes in the market, because you're getting so many good deals right now. You should be pouring money. You should have been pouring money in these companies. And if you poured everything in right now, I couldn't talk you off that. But I also could not talk you off holding a little bit extra to say, hey, this market could still get down 10, 15 more percent. We could see stuff down over 20%, and these stocks get killed. Now, with that being said, sometimes companies will be on a different schedule or correlation in the market. So they might crash before the market goes down. And when the market's going down, because they've already had their huge period where they go through this huge mess, they shoot up. And that's sometimes playing the market. And that's why you got to focus on the market for your cash. But you got to really, really focus on every stock individually, specifically, in a stock picker's market and their intrinsic value. Thank you for watching. Leave a like and subscribe, and let us know if you want to see anything, change anything. We're always open to ears.